Welcome to TheoTrade. This is Don Kaufman. In this video, we are going to be discussing just a little bit about how to use implied volatility from the options to help us allocate capital. And this is something that's, maybe not widely used in the investment and or trading arena, but quite possibly one of the most important lessons that you could ever go through regarding capital allocation. So let's start with some of the basics. And the basic idea of capital allocation is such that here I've brought up the spiders, right? The S&P 500 ETF. Not exactly a thrilling product to discuss, but when you think of capital allocation, if you're to go out and you were to buy, 1,000 shares worth of the spiders, let's assume no margin, of any kind over here. You're just out to, in a cash account, you go out and buy 1,000 shares. Quite literally, what are you going to be tying up? Almost $208,000. I mean, it's over 200 grand you're going to tie up in the spiders for what? Again, the amount of just over about 1,000 shares. And I think that that's fairly self-explanatory, but how and why did you allocate, for instance, 1,000 shares? That sounds like such a large number, like, okay, it's $200,000 of an investment into something like the spiders. Now, the lesson I'm giving you right now, this can be used for investments, for trading, throughout really anything you want to do in the financial markets. So you go out and you buy this 1,000 shares, and how would that compare to if you were to go out, and we'll go take a look at something like Apple. And Apple's this $118 stock. Do you allocate the same amount of capital to Apple as you would into the spiders? And then from Apple, maybe you go and you look at something that has a little bit more risk to it. And let's look at something like GoPro. Would you put $200,000 of capital into GoPro? And you're like, well, it's a $17.94 stock. You just do a little bit of math over there and you start to realize, $200,000 worth of this stock would be quite extreme. And again, I'm using this number of $200,000. It's a completely arbitrary number. The point that I am trying to make, GoPro, Apple, the spiders, they're not just different, underlyings. And I use the word underlying because the spiders is an ETF, and GoPro, what is GoPro? It's a really volatile little beast over here. And then we get something that's middle of the road like Apple. And you cannot justify allocating similar amounts of capital. So I'm going to show you one way to consider how you allocate capital, and that should absolutely be taken into account. So if you look at a product again like GoPro, all right, what I want you to do is I want you to look at GoPro. It's an $18 stock. And I want you to look over to the right-hand side of the screen on thinkorswim here, or, for that matter, any trading application that you're using that has something like implied volatility, which is, again, the implied volatility denotes the risk in the options, But the risk in the options, what do? They can be extrapolated to movement in the stock. So in this case in point, you're looking at GoPro, it's like 70% implied volatility. You're like, okay, well then let's go over to one of the other products that we looked at, which was the spiders. And the spiders, as they bring them up, it's a $208 stock, but that's neither here nor there. Look at the risk metric. The risk metric, being the implied volatility, is showing, 16, 17%. So when you start to compare one product that has 70% implied vol and another product that has 17% implied vol, you better realize, that the 70% product is going to be able to move more. And the analogy I'll give you for quote unquote being able to move more is that if you were to go into, for instance, where I live, Phoenix, okay, or Scottsdale, Arizona, and you were to buy like earthquake insurance in Scottsdale, Arizona. Yeah, the occasional earthquake out here, but there's not a ton of earthquakes like in Arizona. We just sit and wait for them to happen where? In California. So if you were to buy earthquake insurance in San Francisco, it's going to cost, like a ridiculous magnitude, maybe 5 times the magnitude of what it would cost in Scottsdale, Arizona. So the same is true as if you look at the spiders. The spiders are kind of like, Scottsdale. It's like, oh, well, they can move, but not ridiculous like GoPro. And then you look at GoPro as, like, whoa, this is like buying earthquake insurance in San Francisco. Why? Because it can move more. It's got that volatility kind of component to it. So how does this equate to the number of shares, of stock that you're willing to buy or sell? And the answer lies quite simply in respect to, let's go back again to a couple of different stocks in here. For example, you can go out and you can look at a product like Facebook. And Facebook has what? Right around like a 28 volatility. And then again, you kind of compare something like Facebook over to another product like Walmart. Now, you never thought to compare like Facebook to Walmart, but for capital allocation, it's capital allocation. So Walmart's got about rounded to like a 20% implied volatility. Okay. Facebook's got like a 28% implied volatility. Facebook, all right, you're like, oh, so it's 8% more volatile. It doesn't actually work that way. If you looked at a 20% volatility versus a 30% volatility, that product then is 1/3, more risky. So in this particular circumstance, if we looked at a Walmart, and we compared a Walmart to a Twitter, and I like to look at a lot of different underlyings here to get a feel for this. A Twitter, which has almost 50% implied volatility. Twitter is what? Not just slightly more volatile. Twitter is beyond double the volatility, which means we would be using half the capital. And that's really what I'm kind of getting at in this circumstance here. So we're on a product like Walmart. So in something like WMT, in Walmart, if we were to go out and we were to use an amount of capital, let's say we used in Walmart, whatever the investment happens to be, it's like $100,000 because Walmart is sitting upwards near, a 20% volatility. Then how would we allocate to something like Twitter? How would we allocate to Twitter, which has what? In this case, we'll say right around a 47% implied volatility. Would we allocate $100,000? No. Would we even allocate as much as $50,000? No. Because what? You're getting much more bang for your buck at a 47 volatility level. In this case, again, with a little bit of math, you'll start to figure out that, wow, so Twitter is almost 2.5 times as volatile as Walmart. So I don't need the same $100,000. You could say in this case, $40,000. $40,000 goes, as far in Twitter as $100,000 goes in Walmart. This doesn't mean that you should be allocating capital to highly volatile products. It means respect what the implied volatility is actually telling you from one product to another. In essence, and kind of in summation here, always consider, what the implied volatility happens to be of any given product that you're going to trade before you allocate capital to it. Thanks a lot for joining us here over at TheoTrade.